What if I told you that the bank may have already formed an internal risk opinion about your new credit limit increase before even looking at your credit score? Most people are obsessed about a digit number, trying to reach 750 or 800. But while you are watching your score, modern financial institutions are increasingly using internal behavioral risk modeling alongside traditional credit scoring. In 2026, many lenders rely on AI-assisted risk analysis and behavioral underwriting systems that evaluate patterns such as spending consistency, utilization behavior, cash flow stability, and transaction history to better understand future risk. If you ever had a strong score but still receive a denial or had a credit limit reduced unexpectedly, behavioral risk indicator may have influenced that decision. Now, before this sounds complicated, let me explain what is actually happening. I'm Therese Tsague and I'm the owner of American Credit Care, a 4.9 star rated credit repair company. My team and I help people navigate the hidden rules of the financial system every single day. Today, I'm giving you the framework that many institutions use to evaluate behavioral financial patterns, how funding volatility may influence your fundability, and how to position your profile so that internal risk model may interpret your behavior as lower risk over time. We aren't talking about hacks, we are talking about institutional data logic. By the end of this video, you will understand a structural approach that may help position your profile more favorable with modern underwriting systems. To understand behavioral category, you first need to understand Merchant Category Code, or MCCS. Every time you use a card, the transaction is categorized with a code that identifies the type of merchant involved. This is standard payment network infrastructure. Many institutions may use this category as part of broader behavioral analysis system. Now, this does not mean shopping at a certain store automatically lower your score or cause a denial. That is not how it works. But behavioral underwriting system may evaluate transaction consistencies, risk pattern, and spending concentration when assessing broader financial behavior. For example, stable spending pattern across predictable category may align with lower risk behavioral profile. On the other hand, highly irregular spending behavior or rapid spending shift may increase internal risk sensitivity. Again, we are not talking about morality. We are talking about pattern recognition. This is where most people realize the credit score is only part of the picture. Many institutions use automated behavioral analysis to identify what they consider predictive financial stress pattern. And that matters because modern underwriting increasingly focus on future risk probability, not just past payment history. The second pillar of behavioral underwriting is spending volatility. Banks generally favor predictability. If someone consistently spends $2,000 monthly and suddenly spikes to $8,000, automated system may flag that shift for additional internal review, even if the customer has the cash available, because sudden behavior change can sometimes correlate with elevated financial risk. This does not mean a spending spike automatically hurts you, but behavioral system can interpret brutal change as increased uncertainty. That's why consistency matters by maintaining stable financial behavior over time. You may help position your profile more favorable within institutional risk model. We call this conditioning positive behavioral science. You are gradually teaching the system that your behavior is stable, predictable, and manageable. Another important factor in institutional risk analysis is liquidity. Your credit report shows debt, but your bank sees cash flow. It sees balances, it sees reserve. If someone carry high debt obligation while maintaining very low reserve, that may increase perceived risk regardless of their traditional score. This is why some consumers with strong score still receive conservative lending decisions. Behavioral underwriting often look beyond the score itself. In structural fundability review, we pay attention to liquidity positioning. Maintaining stronger reserve balances at institutions where you want lending relationship may help strengthen internal trust over time. Again, not guaranteed, but behavioral consistency matter. And this next part matter more than most people realize. Now we move into the behavioral side of underwriting. Some institutions categorize customers into a broad behavioral spending profile. For example, consumers who regularly carry balances, consumers who consistently pay in full, consumers with stable low utilization, consumers with critical high utilization. In industry language, this is often considered as revolver versus transactor behavior. Transactors are people who regularly use credit cards but pay balances in full, are often viewed as low-risk behavioral profiles. Transactor, people who often but pay balances in full, are often viewed as lower-risk behavioral profiles. Why? Because they demonstrate liquidity, payment discipline, utilization control. This is why many high-profile show frequent responsible usage. Now, let's talk about connected financial data. Many consumers link bank account to app, budgeting platform, or lending system through financial technology provider like Plaid. This creates broader transactional visibility across connected systems. Consumers are increasingly sharing financial behavior data across institutions, often without realizing how interconnected the ecosystem has become. This is why consistency across accounts matters. A structured financial profile matters because modern underwriting is becoming increasingly data-driven. Now, let's get into something consumers never see directly. Every institution has internal lending threshold. This is separate from your visible credit limit. Behavioral underwriting system may influence limit increase, approval, internal exposure threshold, promotional offer. If a lender sees stable income behavior, low credit utilization, predictable cash flow, long-term consistency, they may gradually increase internal trust exposure over time. This is why relationship building matters. Instead of constantly applying everywhere, stronger long-term outcomes often come from building stable relationship with a smaller number of institutions. Behavioral consistency compounds. The future of underwriting is increasingly behavioral. Traditional scores matter, but they are no longer the only layer institutions evaluate. Understanding behavioral risk modeling helps explain why some consumers with similar score receive very different outcomes. You are not just managing a score, you are managing a financial identity. And strong financial identity are built through consistency, predictability, and stability. Disciplined behavior over time, that is the guardian mentality. You protect your financial behavior the same way you protect every valuable asset in your life. If you have a strong score, but still feel like lenders are holding back approval limits or funding opportunities, there may be a deeper factor influencing your profile. At America Credit Care, we help consumers understand both traditional credit structure and broader financial positioning. Click the link down below and book a personalized credit strategy section today and see whether our framework may be a fit for your goals. I'm Therese Tsague. Your behavior becomes your financial reputation. Stay consistent, stay strategic, and I will see you in the next video. Ciao.